So let me introduce very quickly, and I've been there for 25 years. I've been here in ODI at previous conferences. It's a real pleasure for me to be back, of course. Let me introduce very quickly our panelists. On my right, we have Annalisa Prizzon. She's clearly part of the ODI family. She's worked very much on financial issues, and she's also worked with the OECD in the past, and she'll give us a bit of a perspective. We've heard a lot about this broader context this morning and yesterday particularly. Started with the very first section. Gordon Brown gave us clearly a fresh reminder. Yes, indeed, interest rates are low. There is excess of liquidity at the moment. Is it going to last? Yes, no, we don't really know. As a matter of fact, all this liquidity doesn't seem to be going in the right places at the right time. And there are issues, there are pros and cons. I think sort of Annalisa will guide us through that. From that, then we're going to move to basically to Jeffrey Gutman. Again, Jeffrey now is with the Brookings Institution. We had an esteemed career with the World Bank, but he was at one point vice president. And Jeff will take more of from a global, if you will, regional perspective, focusing on Africa. There's a very recent report he's produced with two colleagues, which I strongly recommend for those interested to read. It's very interesting reading. And Jeff will also will guide us through a concept of affordability and equity when you look at investment. And I'm sure we immediately, the first reaction, we're going to take this kind of motherhood and apple pie, but I suspect if I ask 3 people, I might get 5 different answers of the concept of affordability and equity. So I'll have Jeff basically to go a little bit into that and touch also on another thing that has come up in the conference so far, and Philip also raised that this morning, is the issue of data and information. Then if I can move on to my on the left side, I have Amadou Atto is he's going to look again at something that was mentioned in various conferences, is institutions. So now he's heading an interesting institution, is a sovereign wealth fund in Senegal. But he has done various other things in his career, starting with investment banking, and there was a chairman of airport project, again, in Senegal, and so on and so forth. And it's quite interesting to see how this institution plays such an important role in Senegal, and it looks like they may have find sort of a recipe to make certain things we've been discussing this morning, the uncertainty, the financing, and the PP side sort of work. So hopefully he'll disclose for us some of the ingredients and what is the magic recipe to make it work. And then last but not least, as they say, Mark Harvey, again, is a friend of DFID. He's had a long career working on a project across the globe. I think Mark will give us a perspective and try to close the loop, so to speak, go back to the comprehensiveness themes that also has emerged in the previous sessions, and look again at capacity more from a bottom-up, if you will, more from a project point of view. We discuss, again, after discussing financing, etc., he'll give us perspective of what it really means when assuming we can line up the financing, assuming we can have the right financial instruments. Then the project starts, what are the difficulties and the challenges from that point of view. That said, I'll leave Annalisa. You guys have 12 minutes, so I'm going to enforce that fiercely, so good luck.
Thank you very much. Really easy task. I've been asked to kind of talk about who is going to foot the bill for infrastructure financing, and also about some of the implications for public debt sustainability. In an ODI publication, we labeled this decade as an age of choice for development finance, because developing countries have more options to finance their national strategies than 10 years ago. Of course, government revenues are usually the largest source of development finance. This is the case for infrastructure financing and also other sectors. However, there's a trend kind of worth reflecting on when it comes to total public finance. This is not really new to any of you. When countries move up the income per capita spectrum, external official finance, which is ODA, and other official flows, the non-concessional financing from bilateral and multilateral agencies actually tend to decline. This is the kind of yellow line that you can see in your graph. This is an effect, for instance, of graduation out of sub-windows of multilateral development banks and bilateral agencies that decide to reallocate their development programs. Also, and it's a trend that I will reflect upon later on, also the non-concessional financing from official sources has actually been pretty flat over time if one kind of exclude the period of the Great Recession more recently. Reflecting also what Gordon Brown said yesterday, on average, government revenues as a share of GDP, a measure of kind of assess the capacity to mobilize resources, certainly rises as income per capita grows, and this is the kind of red line. But actually, the rise doesn't compensate for the fall in external official finance. At the level of lower middle income countries, so those with an income per capita above 1,000 US dollar, we have defined, myself, Homi Karas, and Andrew Rogerson, actually the existence of a missing middle of development finance. So, how are we going to kind of fill this potential gap or to mobilize additional resources for these lower middle income countries? We understood during the conference that money is only one part of the equation, but it does matter. There are several financing options. I mean, of course, there are grants also for infrastructure financing. I mean, I'm talking about funding feasibility studies. They target the poorest countries, the fragile countries, those at high risk of that distress. But most of the resources are actually in the form of loans. So they do create liabilities to governments. And in principle, they can create a threat for that sustainability. The terms of condition differ, and so also the implications for that sustainability. When I started kind of preparing for this presentation, I actually thought about this metaphor, which is very much related also to the building-related theme. I mean, developing countries often find themselves between a rock and a hard place when it comes to development financing because they need to borrow more. But also they expose themselves to the risk of not being able to afford the new liabilities in the medium term. Often countries do have a debt ceiling, other absolute amounts or relative terms, which might limit the borrowing space even for projects that can generate the cash flows to pay them back. High debt is not a problem per se, probably because I'm Italian, I'm quite sympathetic about it. But in a very simplified way, that becomes unmanageable when it's not really kind of well managed, in the sense it doesn't create the resources to pay it back, either creating the kind of the economic returns, and we talk about it during the conference. The angle I will take is more about external debt, and the reason is simple. I mean, my focus is mainly on the lower middle income countries, and usually domestic markets are not particularly deep, and the interest rates applied on domestic markets are pretty high, around 25%, and I'll talk about this later. Who is going to foot the bill? I mean, I've got less than now 7 minutes. I'm going to focus only on 3 sources. International sovereign bonds, we haven't talked that much about this source. Lending from Chinese sources, we alluded to that yesterday. And I'll elaborate a couple of reflections of PPPs that actually have been cited quite a lot during the conference. So when it comes to international sovereign bonds, taking the perspective of sub-Saharan African countries, actually this graph is quite clear. I mean, the issuances of international sovereign bonds in sub-Saharan African countries actually rose quite visibly since 2009. It was less than $1 billion US, and now we're talking about 6 billion in 2014, and this is only partial figures, and all the credit to our colleague Judith Tyson for this analysis. The average issuance is around $1 billion US, and there are 15 sub-Saharan African countries that issued international sovereign bonds since 2009. And the interesting point is that several of them are actually former heavily indebted poor countries. Other countries decided not to join this bandwagon, and one example is Uganda, and we may want to discuss why this is not the case. When we're talking about the financial terms of conditions of these instruments, they have an average maturity of 10 years. And an interest rate that ranges from 5 to 9%. If one compares it, actually, with other funding sources, and I'm talking about IDA, IBRD, Chinese concessional lending, you can really see that maturities on international sovereign bonds are much shorter and the interest rate is much higher. So why do ministries of finance decide to issue international sovereign bonds? I mean, the first reason is linked to the fact that actually the terms and conditions are usually more favorable than alternative instruments such as domestic debt, and I briefly talked about that earlier on. Second, the international sovereign bond issuances provide a benchmark for pricing corporate bonds in international markets. International sovereign bonds are also part of a risk and portfolio diversification strategies. They don't also bring policy conditionality. The funds are immediately available, and in principle, there's no lending ceiling. Of course, there are kind of disadvantages linked to international sovereign bonds. They might be harder to restructure than bank loans simply because there's a multitude of creditors involved. There's also exchange risk, interest rate risk, and liquidity risk, and this is kind of very much linked with what Phyllis was kind of mentioning earlier yesterday. In a sense, also, the appetite for these instruments is linked to the low interest rate environment that we have at the international level. The exchange rate risk is linked to the fact these are US-denominated bonds, so they're absolutely kind of exposed to kind of fluctuations in exchange rate. Let me go to a kind of point that I probably would like to kind of elaborate more into the Q&A session. I mean, I was kind of wondering, what are the reasons why partner countries decide to go into the international financial markets and they don't borrow more, for instance, from the multilateral development banks? Is that a demand side or a supply side issue? In this later case, should the multilateral development banks borrow more? But I leave it to the Q&A session. The second source I wanted to touch upon is about lending from emerging donors. When we're talking about emerging donors, we're essentially talking about China, India, Brazil, South Africa. In terms of both concessional and non-concessional resources, are much smaller. And there have always been claims, and we talked about yesterday, again during our Q&A, about a potential threat of Chinese lending to debt sustainability. Actually, if you're looking at the literature, there's no evidence about it. There's, first of all, kind of, I'm not saying this is the best model, but often loans are backed up by commodities, the Angola mode. So the kind of debt service of loans, in a certain sense, is guaranteed by that. And also the concept that is applied to sustainability more broadly is about development rather than technically pure debt sustainability. Thinking about projects that create growth, improve terms of trade, diversify export. Let me go to the third kind of flow that I wanted to kind of touch upon, which is PPPs. There's a lot been said during the conference, but when I'm thinking about the analysis on that sustainability, there are a few kind of papers released by NGOs that kind of describe PPPs as a potential time bomb for that sustainability. Actually, again, there's no evidence about this point. These are mainly kind of anecdotes related to that. I want to cite a paper by Matthew Martin, Tim Strawson, and Jesse Griffith. They kind of estimated for the European Commission the relative cost of the different financing options, going from grants to concessional, non-concessional loans up to PPPs. And actually, the most expensive financing means was actually PPPs among all of them. So they might not have a direct impact on the budget, but they certainly can entail a cost in the future. So let me wrap up with kind of 4 final points. Taking the perspective of lower middle-income countries, there are certainly some lessons coming from the crisis of the 80s to kind of avoid another debt crisis coming up. First of all, elaborate and follow through a medium-term debt financing strategy. It's certainly a tool to inform a financing strategy to help decision-making on projects at the macroeconomic level. It shouldn't be just an exercise in the context of the IMF World Bank debt sustainability framework. The second point I want to make is around staff in debt management offices. Usually they're pretty under-resourced. I mean, I remember very recently with Tom Hart, we were interviewing a debt management office in a relatively big country with a very large portfolio, and there were only 3 people managing it. So there's certainly a kind of scope to expand resources for staff and also create incentive to retain staff. The third point, which is related to international sovereign bonds, it may sound trivial to you, but actually when the bond has a bullet structure, so it means that it's paid at the very end when maturity expires. There's certainly scope to create a sinking fund. Again, it might sound trivial, but it doesn't happen to each bond. So just to smooth large one-off repayments. A link to that, avoid issuing new bonds just to refinance old ones. I mean, again, if I want to kind of go back to what Phyllis was mentioning in terms of risks on interest rates are most likely to rise. So this kind of strategy might not be really wise in the medium term. Most of you, I guess, are aware of the example of Ghana, actually. They're trying to issue another Eurobond in 2014, but the macroeconomic conditions were so poor that the credit rating worsened and the interest rate went up. And there was quite a big issue about refinancing it, and the country is now under an IMF program. The last point, but it came up in the earlier session, we need to kind of think about a strong exercise on mapping PPPs, especially when there's a government guarantee into it. It doesn't happen regularly, and I'm thinking about those type of PPPs where, for instance, there are minimum revenue guarantee options. So again, as all we know, PPPs are not captured today in the budget. They may do in the near future. And I'll stop here.
Thank you so much. Lots of issues, lots of food for thought. I have a number of questions myself, but of course I'll leave all these questions to the audience. But it leads in an area which is very dear to my heart, which is what we call fiscal risk analysis, that wraps up a lot of what you've just discussed and may come up in the discussion. Jeff, your turn.
Thank you. Thank you, Marco. And thank you, Annalisa. You actually made it easier for me. I can get rid of the first half of my presentation. Actually, it's very helpful, and though the title of my talk for the next 12 minutes is rather ambitious, I promise you I'm not going to be able to fulfill that ambition because there's not a lot of data and information out there, so I may leave you with a lot more questions, but a lot more targeting for more information and more research and elements of the discussion which haven't arisen that much yet. So just to make 3 points in the beginning, first of all, that despite the SDG emphasis on infrastructure, and now includes affordable and equitable access for all, international attention is focused almost exclusively on financing and supply. And I think when we talk about financing, we all get excited. But now in this one, we're trying to cut down to this issue of affordability. And I actually appreciate very much this ODI conference that has looked more broadly at the institutions, at the implementation, at the varying elements that are required. But access isn't just about building and the bricks. It is also about affordability. So putting a road to a place and the person can't afford to use it, or a metro and the person can't afford to use it, is not access. And so I think we have affordability issues in diagnosing it at 2 levels. The first level is at the government financing level, which I think Annalisa was handling. The second level on affordability is at the individual user level. And that's where I want, if we're going to talk about inclusive and equitable infrastructure building and sustainable development, then we got to include the inclusive element of it, the socially inclusive element of it. To do that, though, I mean, I come out of a specific infrastructure sector, specifically on transport, and it's very hard to think in broad infrastructure with a capital I on these issues of equity, because transport becomes very different than energy, which becomes very different than ICT. And so I'm going to try to delve down into it and give an example towards the end, hopefully I'll get to it, of how on infrastructure, urban infrastructure and urban transport, what are the issues that we deal with in terms of affordability and where do we need to go? So this actually goes to what Annalisa is talking about. Here are the main external financing sources for Africa infrastructure. These are external commitments, not flows. And I've broken them down into 3: PPI from the World Bank PPIF database, China as the substantial lender and supporter of infrastructure in Africa, and ODF, which might be more like your OOF, which includes concessional and non-concessional multilateral financing, as well as OECD bilateral financing. And as you see over time, the amount of money going to Africa towards infrastructure is substantially increased. The blue there is the private sector, if I'm right. China is in the middle, and you have the ODF on the OOF on the top. And you can see quite a significant, the real important one there is the private sector, which I was surprised at. But there is issues that, also you should realize these are moving targets. So you put on the sovereign bond issue. That wasn't even here in 2012. So we're talking about a moving target. So I present these numbers and these data with great deal of humility, because you're chasing your tail trying to get this information together. But without being able to understand what's going on in what sectors and what countries, it's very hard to then to talk about how to solve the issues. So we were looking to see if there were orphans. And so when we looked at external commitments to Africa by country, you can see almost, 53% is going to 5 countries. So a large amount of it is going. So you kind of look to see if you have orphans. So then we looked at it as a percentage of GDP, and the blue is actually the earlier years, 2005, 2008. The red is 2009 to 2012, and you can see, very interesting, these are the top 10 and the bottom 10. Top 10, you can see, I think 6 out of the 10 are low-income countries. It's very interesting. Part of that is small GDP, so that any flows are pretty high. The high one is Liberia, and that's really the issue. On the bottom end, it's a combination of those with natural resources, large economies like Nigeria, in which as a percentage of their overall budget, it's not very high, or GDP, and some more on the fragile side that are having a hard time attracting funds. But I would not be, I'm reluctant to put this up here as a percentage of GDP. It's important, but a road costs the same whether it's in Liberia or it's in Ghana. It's going to be, the infrastructure is infrastructure. And I think as a percentage of GDP, one needs to be really careful about looking at it in relative terms. You almost need absolute. And this is the external financing by sector. And you can see that energy is growing. ICT, I think, is the middle one. And that's actually stabilized after growing quite a bit. Transport stays large. There is some specific projects. That's another thing. In Africa, you get one big loan for a railway or a road, or in power, you get ESCOM, and it starts moving your numbers very radically. And then water on the top, which is a much smaller element. What's interesting is when you overlay the sources of financing with the countries by sector, you start seeing something pop out at you. And this is where we're looking at PPI, private provision of infrastructure, as distinguished from PPP. You can see that it looks like a lot of countries are getting private infrastructure money. And that's about 40 countries out of 52 sub-Saharan African countries. When you take out ICT, that goes down to 21. So basically, private sector money in infrastructure is going either to ICT across the range, or it's going to certain countries, mainly for energy and somewhat for transport. And then you get down to the subsectors. In transport, it's mostly for ports. And so even at the subsector level, you have to distinguish. So what does that mean? I've given you a very short, the paper, which was done with Amadou C. and with Sumia, I would say Sumia C, because I can't pronounce his last name, is available, and you can see much more of the details, but we don't have time to go into it here. The question mark is as to what we find from these results. And I think we found that there's a bit of a serendipitous complementarity of sources of financing going everywhere. You have the Chinese going into a range of countries, you have PPI going to a range of countries, and then you have the ODF going to a broader range of countries because of the nature of how they allocate. What I do see, though, is that the MDBs, particularly for low-income countries, remain incredibly important. Those who have basically proposed the end of the MDBs, I think their role is still there, but it's different. In low-income countries, it's financing. In middle-income countries and other countries, it's more leveraging. More broadly, it's about issues beyond leveraging. And leveraging, I would say, look at guarantees, very importantly, because one thing that came out of the PPI numbers is, are these guarantees going to the right countries that really need it and the right sectors, or are they taking low-risk opportunities? I mean, we don't have those numbers. I haven't been able to put them together yet, though I'm assured I can do that, so I would like to do that. But the MDBs still have especially still a role in terms of setting standards as an independent voice to help if you're receiving a bilateral support for a project, be able to define the economic feasibility, financial feasibility of it. I think they still have a major role, but it's a different role, and it's a changing role. And following Addis, I think there's got to be a major discussion, I think we're all talking about that, as to how they can evolve. Next year is actually an important year because you have the negotiation of IDA and ADF, the concessional loan windows of the AFDB and of the World Bank. And it's a really important point to take another look at how we distinguish countries who can afford it, who can be actually available for IBRD funding. We might need to change that. And I would put the second point here on domestic finance, we don't find a lot of information on. I mean, there isn't. The IMF put together what they can, but their projections basically on domestic financing for infrastructure is very limited. And you have ICA, the Infrastructure Consortium for Africa, that reports on some countries, but there is no overall view that I've been able, maybe Annalisa has come up with it, on how infrastructure is financed, and particularly relative to what we talked about this morning, subnational. And I think subnational is the great opportunity. I want to finish off with a discussion, though, and put a few points on the table about affordability and equity, and specifically look at urban transport. I think the one problem we have when we're doing affordability and equity and access is defining what is the metric that we're going to use to define availability and accessibility. And for urban transport, it's really difficult. For energy, we know how to do that. For access, when a household has access to energy, we know for water, we know for ICT. Even for rural roads, you'll see outside talks about how many people are within 2 kilometers or not 2 kilometers of an all-weather road. Urban transport, there's no metric. And the way we do economic evaluation is based on efficiency and value of time. And when you get to the issues of equity and affordability, we need something that is more broadly defined. And we talk about access and how do you measure urban access. And what's interesting about it, it requires the combining of land use as well as transport, because the solution is not necessarily an infrastructure solution. And how you're going to finance and how you're going to put together is very different than you might do in other sectors, and specifically for the urban areas. I also talk about adaptation of conventional economic evaluation, that if we're talking about user savings, and we talked about one project on that this morning, user savings means time values. Time values are higher for higher income people. Does that mean we build just for higher income people? Do we take care of the access needs of the lower income population? Do we take care of the transport needs of the lower income population? And I think that's a question mark, and we don't have a good amount of data. What is great, though, is that new technology, GIS, GPS technology, is allowing us to do more of that, but we don't have the models to do it yet, and we're trying to develop that. And finally, it comes down to pricing. And subsidies is like a dirty word. We're trying to get rid of all these energy subsidies and other subsidies and user pay. But when it comes to affordability on urban transport, we're going to have to talk about subsidies. But we're going to have to talk about it in a new way. Really targeted. We actually have technology. We may be looking at the way we do cash transfers and actually look at that in more lump sum type orientation, but we have identification technology that we can do better in terms of targeting low-income populations and others that need help in terms of transport access. But we need to align it with pricing objectives, and that's a problem because we have congestion pricing, which goes one way. We have climate change pricing and use of fuels, and then we have social pricing. So I leave you with basically these questions for more research, but what I do argue is that it is really crucial that we incorporate social inclusion in the application of sustainable development principles to infrastructure. Thank you.
Thank you so much. You touch on two very important aspects. One is the involvement of the private sector. There's been a lot of talk about PPP, but the private sector still plays quite a role. And then you hit on the word that typical economists tend to react and develop allergies, which is subsidies. So it so happened as hot from the oven, ODI has just produced a paper, which I haven't seen yet, but the title seems to be apropos. So with permission of the other speakers, I'd like to call on Paddy Carter. So the paper was just issued, and the title is Why Subsidize the Private Sector? What Donors Are Trying to Achieve and What Success Looks Like. So Paddy, please, just a couple of minutes though, okay?
Okay.
But I think it's exactly very much crucial to what we're discussing here.
Well, thank you very much. Here's the paper. It's available in the foyer, so please pick up a copy.
So it's free? You mean it's free?
It's free, yeah. Subsidised, yes. Yeah. And I wrote this paper because we hear so much now about using aid to catalyse private investment, and some of this is verging on magical thinking. You know, you put $1 of aid money in, and you get $20 of private investment out, and it's marvellous. And I think that if you think about what these smart levers really are, they are subsidies of one form or another. And as soon as you recognise that, that means that it means two things. First of all, you think about subsidies properly. There is a case for subsidising private investment. It is a valid use of aid, but it's a case based on public economics and not about trying to turn a small number into a big number. And the second thing is that this idea of mobilising private finance, it can't be pursued in isolation. It can't be separated from the business of locating projects maybe I should say developing as well, projects which are worthy of a subsidy. So the paper looks at the economics of subsidising the private sector, and the last thing it touches on is something I haven't heard much about yet, which is about what we can expect in terms of results monitoring and impact evaluation in this field. I'll leave that there.
Thank you
Thanks
so
a lot.
much, Paddy. Thank you so much. So, and as I anticipated now, Amadou is going to tell us a little bit of particular institutional setup in Senegal that seems to be bearing fruits, but I'll let him speak to that.
Thank you very much, Marco, and I'd like to thank the ODI for this great opportunity to share some of the things that we are doing in Senegal and also learning about what other people are doing as well. FONSIS, the institution that I run, is a strategic investment fund of the government of Senegal, which we founded 3 years ago by law, but effectively 2 years ago. I've been running it as a CEO. I'm the founding CEO of the company. We are 100% owned by the government of Senegal, but run entirely privately with a team that has a background of investment banking, private equity, coming from multinationals, with a mandate to invest and co-invest, develop strategic projects in strategic sectors that are defined by the government, including, of course, energy, infrastructure, and so on and so forth, but also invest in SMEs directly or via some SME funds that we are setting up, that we have set up with other investors. So the idea here for the government is basically to put their money where their mouth is, but also to have a strong team that can in a credible manner face the private sector. We've done that on a few projects successfully, one with Merijam, a solar project, 30 megawatt. Within a year, we were able to develop it and reach almost financial close. We are hoping to get financial close end of November and start construction as well. Negotiations were very fast because FONSIS had the right team to face Merijam. So this is a great, let's say, example. The second example is actually Polymed. The government of Senegal has an issue in, let's say, upgrading the infrastructure in public hospitals. So most of our public hospitals, in particular outside the capital, are almost run down, no enough x-rays, no enough, let's say, diagnostic tools. So patient travel 100 kilometers, maybe 50 or what have you, to do, let's say, an X-ray. So we came up with this idea that was approved by our board end of December last year to run a pilot phase where we would create a subsidiary initially owned 100% by the sovereign fund that will sign long-term agreements with, let's say, the public hospitals, whereas we build the diagnostic centers inside the hospitals, we acquire the equipment, like the radio, the endoscopy, and all of that, but also manage the existing infrastructure of the hospital and bill directly the patient and share the income with the hospital. So that was a new model, and the government approved it, the Minister of Health. And within less than a year, we were able to do all the feasibility studies, to negotiate the contract with the public hospital, to hire the architect, to run transparent processes, to hire the construction company, to put our own equity and raise debt on the local market, and also to construct the facility. The pilot phase is on land of 1,000 hectares, 1,000 square meters inside one of the hospitals in the tourist area. And the 21st of December, we will inaugurate that project. We are buying the X-rays and a lot of machines from Philips of the Netherlands and another Toshiba. We did this all through a very transparent process, and we cut the cost down by more than 25 to 30% compared to the equipment that were acquired by, let's say, some hospitals, right? So by doing that process and by efficiently maintaining the infrastructure, we will be able to provide a much better service, world-class facilities inside a quasi run-down public hospital, and at the public price that the hospital was billing the patient. That was the condition, really, to not increase the price. And we were able to do that, one, because we hired a very good CEO, a lady that used to work for GE in the US. She spent 14 years at GE building medical equipment. We ran a process, transparent process. We got 120 CVs, and she was by far the best person because she was manufacturing GE equipment, but also she was working in a private clinic project in Senegal, so she had that also managerial capabilities. And she's been appointed as CEO, and we put a small team from Francis, some external consultant, and managed to finalize this. Now the Minister of Health wants us to replicate this all over the country. So we are building there a champion that will be focused on medical infrastructures in Senegal and maybe later overseas. And with $1 from Francis, we were able to mobilize $2 from the banking sector. So it's 3. If the government was to build on its own that facility, the hospital would have to put the 3 on their own. But us as an investor, so it's kind of public-to-public partnership, because on one hand, we own 100% by the government, but we own privately, we're a bit hybrid. And the idea is to do initially these projects and then open the capital to the private sector. So later on, we will talk to some investors, insurance companies, and if it becomes big, then we can list it on the regional stock market, at a later stage. So these are the things we are trying to do, and that were successful. And the government is now very happy to see these results. So big projects, much bigger projects like the LNG projects that we are planning to do, and a power 600 megawatt with some Japanese and Middle Eastern investors. We have, let's say, we are at the center of the discussions, even if the PPA is signed by the state utility with the sovereign guarantee. All the gas infrastructure, we will be a core shareholder with the international partner. And the international partner likes it because they're saying we walk the walk, talk the talk, and we understand risk and returns, and we are return-driven. Return with impact, but number one is returns. No returns, no investment, no involvement of Francis. So that was very important. And there is a toll road also where the toll road is very profitable. People are complaining, the MPs are complaining that the government did not sign a good deal when we did the toll road in 2011. So now we are negotiating so that the sovereign fund can take a stake in the toll road and be a significant shareholder, so that socially and politically that project that maybe were not negotiated very well 7 years ago becomes maybe more acceptable. And with that same company, we are trying to build more toll roads as well in the country. Just in terms of mobilizing capital, typically in our projects in Africa, or I mean in Senegal or other parts of Africa, we strongly believe at Francis that DFIs that has significant amount of capital or that could raise a lot of capital, cheap capital, should also really be faster, should reforms, because often the processes are very tedious. In particular, if you need to coordinate many DFIs working on one transaction. And also, we believe that the DFIs who knows more Africa and who have a kind of intrinsic political cover should take more risk. And maybe then they can, to fast track financial closing, and then later, once the project is running and cash flows are happening, then sell down maybe to other DFIs or to other investors, including having a project bond that is not issued by the government, but by the asset itself, because it's already operating, there is no construction risk and all of that. We strongly believe that if you can have that, the DFI or some investors underwriting the project and then later selling down, you can bring in more private sector money. Lastly, I saw a chart, the previous chart that actually a gentleman from Brooks, I don't remember, Jeff, sorry. We have the private sector money, we have China, we have all these development money or donors money. It's actually private sector versus government, because China puts money, it's not private money. It's the African governments borrowing the money or giving sovereign guarantees, borrowing, therefore increasing their debts outstanding. So it's government money. It's just coming from China. It's not private money. The government also issuing a euro bond. It's government money because it's the government who's borrowing. If you do a euro bond, you don't have a sovereign guarantee, no investor will buy it. So it's again government money. So if you look at the chart, $25 maybe billion, maybe 70% is government. So the issue is, and I totally agree with the paper that actually was written by Paddy, not only the aid money to bring in private money, but the entire government money, how can you use it to bring much more private sector money? And it's not just, let's say, giving guarantees, but it's also being an equity shareholder with the private sector. Because often the private sector will ask for many guarantees and does not want to take a lot of risk, which is normal. It's a private sector. But if the project becomes very profitable, because the government has given all these guarantees, like traffic guarantees, has given a subsidy maybe even on the investment side, if the project becomes very profitable above a return threshold, there should be a mechanism where the government will step in and share that excess returns above a threshold. And this is what we are trying to say on the toll road in Senegal. The project became very profitable, but initially government gave so much subsidy, investment subsidy, used the government money to pay populations to move out of the way and all of that. Project became very profitable. Ridiculous, let's say, returns. I mean, of course they took risk, but there should have been mechanism where that if the returns level is very higher, above a certain level, the government should come into that and share that return. So now we are trying to get into the project and telling the private sector, don't you evaluate and charge me the subsidy that the government gave you to reach this very high return. So these are the kind of discussion. If we want to avoid the political issues and the social issues in the future, up front, there should be a mechanism in all PPPs to make sure government steps in if the private sector gains a return superior, maybe, I don't know, to 20%, 25%, depending on the risk profile of the country. Thank you very much.
Thank you so much. I wonder whether I've been too strong in threatening my panelists on the time, because we seem to be ahead of time now. So, Mark, so give us your perspective a little bit on the constraints that you've seen from actually using the money and actually try to build something.
Well, I'm first of all grateful for being invited to this conference. It's been really interesting. I've learned a huge amount. And thanks for asking me to speak on the panel. I wasn't really sure actually what I was going to say because I'm not an investor, I'm not a researcher, I'm not a financial analyst, but I've worked for DFID for quite some time. So I'm actually going to revert to one of the questions which was on the agenda, which is, how can governments effectively work with providers of development assistance to address the constraints? And as I worked for a provider of development assistance, then just a few things about DFID's approach to infrastructure and what we think. And I've done this in line with the general themes of the session so far. So the session one was on the big picture, and I realise I'm not trying to take the closing session thunder, but the big picture, we get that. I know the bit of the theme is we've been here before, 1994 World Development Report, but and the gentleman from Pidge this morning referred to the pictures not having changed very much. But I think things have changed. We invest in programs through country-led approaches. We conduct growth diagnostics at country level, at regional level, and even at global level. And DFID established an economic development directorate about 2 to 3 years ago. So I think generally things are better. The second session was about what to build. And I would say, there's a lot of talk about projects here. I don't think we get involved in particular projects, maybe occasionally. And we don't think it's actually our decision. It's a country's decision to work where they think it's best to work, although we might have views on that. But I guess there are some things about the way we go about our programs that perhaps partner governments can learn from. We have a much stronger business case methodology than we had about 5-10 years ago, a much more rigorous appraisal process, and a very much stronger effort on the evidence base. And alongside that, we, on thinking about what to build and where to build, we address the politics and other governance issues, I think, more strongly than we have done in the past. That includes things like working through the cost initiative, but also increasingly undertaking sort of political economy studies. Converting plans into action, which was the third session, I think we would echo the World Bank's remarks about shifting the balance from the effort placed in design through to implementation. Now we've introduced an internal accountability mechanism in DFID called a senior responsible owner, and I think that resonates with something that came up in one of the sessions about, so who's accountable when things go wrong, or hopefully who's accountable when things go right. And lastly, on the cities session and urban infrastructure and infrastructure generally, we produced an infrastructure policy framework last January. We've recently issued an energy policy framework. We're about to produce an urban policy framework. Lots of frameworks. But in summary, what all that means is we've had to think, where's our comparative advantages as a bilateral, which people tend to think we don't do a lot in infrastructure, but actually we do quite a lot because we do a lot in the multi-buy agenda through the multilaterals. But we concluded that our comparative advantage is sitting alongside the likes of the World Bank and others with what we've called nimble, politically astute technical assistance. And that gets at the political capital agenda. I'll say it again if people want to get that neat little phrase. But what that means, we've supported things like NIAF, which is the Nigeria Infrastructure Advisory Facility. And that's one arrangement. We're just launching a program called Infrastructure and Cities for Economic Development. And as a bilateral agency, we obviously work closely in country with our foreign ministry colleagues in embassies. So that political angle can sort of occasionally remove obstacles, one hopes, and open doors. We obviously support Pidge, we have done for a long time. We have CDC, and we're designing a new instrument of development capital. So that's what DFID's doing. It wasn't supposed to be a presentation about what DFID's doing. That's what it's become. But what do I pick up from what governments can do? And I think just some notes I made as we were going through. I think they need to get better at measuring and maintaining what they've got already. Why would the private sector get into countries and certain sectors if they see the current state of the infrastructure stock and the effort that's put into maintenance? There's huge backlogs and assets aren't maintained. So I think that's important, and you've already said the theme about more data. So addressing tariffs and collecting revenue. What is government's current performance as a measure of what its performance is likely to be in the future. I think the second theme is being more open and transparent about plans. That includes signing up to cost, but getting at the politics. And I guess the other theme that's come through, and the sort of thing we're supporting in some countries, is the independent units and facilities at a national level, to try to get some of the politics out of infrastructure, perhaps. And then the third thing is the focus on implementation and delivery, the starting and completing projects before embarking on the next master plan. I've seen that in plenty of places. And I guess the third theme, which is rather unusual, because I normally come to things like this and I normally downplay the engineering side of things. I am an engineer, but somebody did say yesterday that building things is actually quite complicated. And the ODI team did invite me to say some other thoughts that were not necessarily on the agenda, and I think it's the issue that has been mentioned in a few cases about the capacity in country. There aren't enough engineers, there aren't enough planners, and the private sector need them as well, even if you bring in the private sector. I was at an event at Chatham House recently, and the private sector companies were saying that they can't find the people to work with locally. They haven't got the capacity, the technical capacity. So there's something in there about how we train infrastructure specialists, technical and planning issues. I think that gets at some of the problems that the private sector will face and governments will face. The estimates are wrong, prices rise, projects overrun, and there are always unforeseen ground conditions, which leads to all sorts of problems around corruption and estimates and material and that sort of thing. So my take on all of this is, while DFID is supporting a lot of things like PIDGE and putting in facilities and doing the analysis, I think there's still a strong push that we need to do on the technical capacity building side. And I never thought I'd end up talking about engineering at something like this, but I guess that's what I'm alluding to. Okay.
Thank you so much. So I think we covered quite a bit, so I think it's time to open the floor. Just one technical... I don't have I was promised an iPad, so that I can see whether there are questions coming from around the globe. So if somebody can keep an eye on that and pass on any questions we might receive, otherwise we'll stick with yes, no? Yes, okay, cool. Okay, it seems that I was just accidentally looking on the right side. Okay, please, I have already two hands over there, please.